Welcome back to another video. This is going to be another broader real estate video diving into mortgage rates and my expectation for 2026. Because in my opinion, mortgage rates are going to decline as we move further along into the year. And I'm going to talk a little bit about why, what directly impacts mortgage rates, because it's not necessarily the Fed cutting rates. And we'll get into that later in the video as well. Give an example as to when the Fed cut rates by 1% and mortgage rates actually went up by 1%. So let's get straight into the video. This is a chart of the 30-year fixed mortgage rate, which is the green line above, and below is the 10-year Treasury yield. And what you will see is that they are identical. They are so correlated that when the 10-year Treasury yield moves, mortgage rates follows. And what impacts the 10-year Treasury yield? Well, you have a multitude of factors. Number one being the amount of yields that are being purchased, the amount of bonds that are being purchased. The higher demand for bonds are, the lower the yield. The lower demand for bonds are, the higher the yield, because the government needs to increase the yield, the rate of return, in order to bring in more demand. Now, the 10-year Treasury yield historically has been pretty low, at least pre-COVID crash that we saw. And for the last 5 years, you can see that the 10-year Treasury yield has gone from 0.5%, which is essentially when the Fed cut interest rates to next to nothing, when we had massive unemployment and a very brief recession. It has been going up ever since. And we peaked right before 2024 started, when the 10-year Treasury was around 5%, and that's when we saw the 30-year fixed get up to around 7.5%. Almost 8% on some databases. I know a few lenders that were actually doing 8% mortgages at that time. And this is sort of when the housing market in the overall United States started to slow down. When mortgage rates, well, it was really in 2022, when mortgage rates started rising from, when the 10-year Treasury got above 3%, mortgage rates were closer to that 5.5, started approaching 6% levels. That is kind of when the housing market started slowing down. And in some areas, we saw inventory outpacing demand and started to see quite a few price reductions. And the 10-year Treasury yield has sort of been steady between 4% and 5% since 2024-ish. So fast forward to when the Fed started their interest rate cuts, which was leading up to the election in 2024. They started in September, cut in October, as well as November. And we saw the Fed cut rates 50 basis points, 25 basis points, and did another 25 basis point cut. And that led to a full 1% interest rate reduction. Now, what can we see happen during that period of time? Well, as you can see in September, which is when the Fed started cutting, the 10-year Treasury yield started increasing. It went from 3.6% to almost 5%. I think it was 4.8%. And mortgage rates went to 7%. So that's an example of the Fed cutting interest rates not necessarily doing anything for mortgage rates and the 10-year Treasury. Mortgage rates went to 7% from 6% after the Fed cut rates by a full percentage point. So what does that tell you? That the Fed cutting rates doesn't necessarily have a direct impact on mortgage rates. I'll discuss briefly why this actually happened. So after the Fed cut rates, the economic data proved to not be bad at all. In fact, we saw unemployment decline and inflation started going up. So this told investors that the Fed probably should not have cut rates because inflation started rising and the unemployment started declining. So the economy was looking very, very strong. And everyone was scratching their heads saying, why did the Fed actually cut rates a full percentage point when clearly the economic data was not suggesting that they needed to cut? We still had historically low unemployment and inflation was still an issue. So investors took that as a mistake. Investors said, hang on a minute, if they cut too soon, maybe they might actually raise interest rates if inflation carries on going up and the unemployment starts to decline. Remember, this was during the time when Trump got elected and he was about to implement an enormous amount of tariffs. So already there was this fear that inflation was going to get out of control yet again. So investors said, If this is in fact the case, the Fed messed up, they shouldn't have cut rates. Now they might actually have to raise rates to fix their mistake. And that is why the 10-year Treasury went up 1%, and so did mortgage rates. So where do we stand now? Well, we have here's the inflation report, month over year change. Inflation right now is at 2.7%. And that is down substantially. You can see we've been in a downward trend. Obviously, inflation peaked around 9.1% in 2022 and had a huge fall off when the Fed started raising rates. And now we are seeing inflation in a slow downtrend. You can see it sort of bounces up and down, goes from 3 to 3.7 and continues to go down. In 2024, it was 2.4%. And now we are seeing inflation slowly start to decline. Now, obviously, tariffs have been a large discussion point for the last year, and as to whether or not they are going to directly impact inflation. That has yet to be seen. Obviously, still a lot of time. We'll have to see if inflation does in fact get out of control and starts to rise yet again. But what I find very interesting is that the Fed cut rates multiple times again in 2025, and inflation is sort of hovering around this 2.7, 3%, sort of bouncing in between, give or take a few decimal points. Yet they're probably not going to be cutting rates into the summer. They're probably going to just wait and see what happens. Do tariffs have a impact on inflation? Are we going to get higher than expected inflation? So they're probably just waiting to see how everything plays out. And that is one factor that impacts the 10-year Treasury, which in turn impacts mortgage rates. The other factor is the unemployment rate. We have a Federal Reserve that has stated time and time again, they are monitoring the unemployment. They, A, don't want to let it get out of control, and B, they're not going to cut unless the unemployment is a little higher. So as it is sort of remaining in these relatively low levels at 4.4%, the Fed doesn't necessarily have a reason to cut back to back to back. They did 3 cuts already. So far, that hasn't caused inflation to rise, and unemployment has been on a slow increase. We've gone from, let's see where we were. We've gone from a little over 3% to now 4.5%, 4.4% in the recent set of data. My expectation is that the unemployment is going to continue trending higher. The historical average for the unemployment is 5.8 to 6%. This is going back 70 years of data. So I believe the unemployment rate is going to continue trending back to more of those normal levels. I think we are eventually going to see unemployment in the fives, maybe mid to high fives by 2027. And if that does happen, remember the trend is up. Unemployment is going up. We saw 1.2 million layoffs in 2025 in the United States. I do believe layoffs will continue to be a factor in 2026, and that will cause a rise in unemployment. I do believe inflation is going to go down despite the narrative that we are seeing right now. Remember, consensus for the last year has been that inflation is going to skyrocket. We've yet to see that. What we have seen is a huge decline in energy prices. Oil is a huge factor in terms of overall inflation. Most of what we consume comes from overseas, which is shipped in a tanker. And if oil is cheaper, generally, you're not going to see a huge rise in the cost of goods. So that has been a factor. We're also seeing shelter. Housing, rent has started to experience deflation. If you look specifically here, shelter, you can see that has been on a massive decline. Shelter peaked at 8.1% and shelter inflation is now 3.2%. This is a downtrend. This does not look like it's going to be going up anytime soon. So that is another large factor of the overall inflation. Shelter and energy make up roughly, I believe the stat is 70% of the inflation number. So if we have both of those factors declining, which they have been for the last 2 years, then you're probably going to see inflation decline as well. Obviously, the caveat is going to be tariffs, whether or not that significantly impacts the inflation number or not. We actually saw producer prices declining month over month and year over year, which is a great thing for consumer inflation, because if producer prices are declining, you would hope that they are not going to be increasing the prices for consumers. If we saw producer prices skyrocketing, we saw producer PPI at 3%, 4%, 5%, you would 100% assume that consumer inflation would be increasing as a result. As of right now, we're not seeing that producer price increase. That is essentially what companies pay for goods. And if that is flat year over year, you would expect that consumer inflation would also be flat year over year. In my opinion, unemployment is going to be a more important factor, a more significant factor when it comes to the direction of the 10-year Treasury and mortgage rates, because the Fed is absolutely not going to want to get themselves into this scenario where unemployment is getting out of control. Because if you look back historically, once it really starts going up, it doesn't stop until the Fed cuts rates massively. We can even see during the 70s inflation crisis, unemployment went from 4.8 to 9%, and then went all the way down. And then again in the 80s, inflation had another round going up to almost 11% in 1982. The Fed does not want this to happen. And in my opinion, they should continue cutting rates because unemployment is going to be a more significant impact, or is going to have a more significant impact on the economy than inflation going from 2.7 to 3.5% or 4%. On top of that, when the Fed cuts rates, same as when they hike rates, it can take a year to a year and a half for that to actually have an impact on the real inflation numbers and the unemployment numbers. As of right now, we are seeing a lot of companies continue to lay people off. We know the job market is terrible right now. We know not many companies are hiring. So if the Fed is too late on this, they're going to have to do emergency rate cuts. As it stands, we're not in that environment yet. So I personally think the Fed is probably going to not cut in February, March, and maybe April. They may start cutting in May and June. Jerome Powell's term is up, I believe, in June. And whoever replaces him is probably going to do whatever Trump wants, because Trump is likely going to be the one that appoints him. So in my opinion, we will get more rate cuts in the second half of the year. If inflation does start to rise, and we start to see 3% prints, 3.5% prints, 4% prints, that is going to be an absolute disaster because the Fed may actually have to raise rates in order to combat that. And that would absolutely send the 10-year Treasury yield higher and mortgage rates higher. But as it stands, I am sticking with the current data that we have, and it does look like inflation is in a pretty significant downtrend, so I would expect that to continue in 2026. That's kind of my argument as to why I think mortgage rates are going to continue declining into 2026. We talked about unemployment, we talked about inflation. Inflation has been in a downtrend, unemployment is in an uptrend. If anything were to change with that and we see back-to-back data sets suggesting that unemployment is actually declining and inflation is actually rising, then obviously my opinion is going to change. But as it stands, this has been my opinion for really the last year, year and a half, that mortgage rates will likely slowly trend down as time goes on, as we get back to those historical average levels of unemployment between 5.8 and 6%. Let me know your thoughts in the comments. If you like this video, subscribe for more. Check out my website below for a bunch of free information, and I'll see you next time.